Hey, I bet you were expecting Maxwell Smart to show up at the end of that hall. Oh well, sorry to disappoint you. This is Joe Henry with another video on dividend stock investing. If you haven't seen my first video, Double Your Money Investing in Dividend Stocks, I would highly recommend it because it's amazing and wonderful. Now tonight, I'd like to speak a little bit about the pandemic before we get into the topic for this video. As you know, we've been in the pandemic for a while now, but this week there seems to be a glimmer of hope. It seems to be stabilizing in the major cities around the country. If so, we will have gotten off relatively easy compared to the last three pandemics we've had in the past 100 years. Even relatively easy compared to the flu season we had 2017 to 2018, in which 80,000 Americans died from that disease. So hopefully things will continue to improve. They could always get worse again in the fall. We've been told that by a number of experts, but all we can do is hope for the best. Now, market observers believe that the market put in a bottom on March 21st. So hopefully several of you were able to take advantage of this big dip we've had in the stock market lately and buy up some good stocks. What I'd like to show you now is a chart of the S&P 500 over the past 140 years and kind of show you the impact of things like pandemics and some other events on the stock market. Now, as seen on this chart, in the 20th century, there were three flu outbreaks: 1918, 1957, and 1968. Three outbreaks of flu which were labeled as pandemics. Now, the most significant was the Spanish influenza, 1918, which is the catastrophe against all the modern pandemics are measured. At that time, approximately 20 to 40% of the worldwide population became ill. Over 20 million people died. In the U.S. alone, about 500,000 deaths. And for comparison's sake, in a typical flu season in the U.S., anywhere from 12 to 50,000 people die. However, as I previously mentioned, in the 2017 to 2018 flu season, 80,000 people died in the United States. And amazingly, there wasn't much media coverage of that. Nevertheless, in 1918, the S&P 500 did fall, but not by that much, 24.7%, which in my opinion is not too horrible, considering the global devastation that had just occurred. If you remember back in part one of this series, a bear market occurs when stock prices fall more than 20%, but no greater than 40%. And when this does occur, the average duration of a bear market is 11 months from peak to trough, and then another 14 months to go back to the baseline. So in other words, prices return to the previous baseline about 2 years after a bear market would begin. At the 1918 pandemic, the S&P 500 rose by 8.9% in 1919, the year following it. Now, in the Asian flu pandemic in 1957 here, this was the second most significant outbreak in recent history, and as you can see, 116,000 people died. Now, unlike the virus that caused the 1918 pandemic, the 1957 virus was quickly identified. A vaccine was available by late summer, and actually in that year, the S&P 500 index actually rose by 24% in 1957, and then another 3% in 1958. Now, in 1968, we had the Hong Kong flu. Now, deaths from that virus peaked in December of 1968 and again in January of 1969. Here again, the S&P 500 index rose by 12.5% in 1968 and then 7.4% in 1969. Now, in 2003, we didn't have a pandemic, but we had the SARS epidemic, and this outbreak began in April. Now, 6 months later, the S&P 500 was up 14.5%. 12 months later, it was up 20%. So much for gloom and doom. However, we also went to a war with Iraq in 2003, and as you know, there's nothing like a good war to boost stock market returns. So taking another look at this chart of the S&P 500 over the past 140 years, does it look like pandemics have had much of an effect on it? Not really. Another good example of why time in the market, not market timing, makes the most money in the long term. So there you have it. Worst pandemic in history, market goes down about 25%. The next two pandemics, market actually went up. Go figure. What's going to happen this time? Who knows? It's just one of life's mysteries, like, why doesn't McDonald's sell hot dogs? And what's with that Easter bunny carrying these eggs around in a basket? Everybody knows rabbits don't lay eggs. And where does your pen go when you drop it? So a quick review of my earlier video, Double Your Money Investing in Dividend Stocks. We talked about dividend aristocrats and dividend champions. Well, champions are a group of stocks. There's about 184 of them right now. Dividend aristocrats are a subset of the champions. There's about 57 of them this year. The champions and the aristocrats have both increased their dividends over the past 25 years, so they're pretty amazing. The aristocrats are extra special in that they are also listed on the S&P 500. They're all U.S. companies. They all have over a $5 billion market cap, and there's some other special requirements for the aristocrats. But for our purposes, the champions are just fine. Now, both types of stocks offer products and services which are basically recession-proof. They're taking in profits year in, year out. It doesn't matter what happens to the economy in general. And they do have a higher return with less volatility than the S&P 500. I left everyone with a cliffhanger from part one. Okay, what would happen if we purchased just those dividend aristocrats or champions that were trading below their fair value, as calculated by a discounted cash flow method? Well, let's do that. That's the subject of this video. We're going to use some financial metrics to find some of these undervalued stocks. For example, the PEG ratio, like the PE ratio, but it's the PE ratio to growth, overall earnings growth. So it's a better metric to use than the PE ratio by itself, which does not take into account growth. We're going to look at price to book ratios. We're going to look at dividend yield, show you why it's important to be between 2 and 4%. The higher yielders don't perform as well. And the lower yielders, well, why bother? You might as well just buy a CD. Other metrics we're going to use, dividend payout ratio. This is the percentage of a company's earnings which are paid out in dividends. It's generally believed that if a company's paying out greater than 50% of its earnings in dividends, they are at risk of, that dividend might be at risk since it's a fairly high percentage of their profits that they're giving back to shareholders. On the other hand, if they're only paying out less than 10% of their earnings as dividends, then that company's kind of stingy, and we would call them not shareholder friendly, and we would avoid those companies. We're also going to demand a dividend growth rate of at least 8% per year over the past 10 years. And finally, the stock price, we want it to be less than the fair value as calculated by this discounted cash flow method, which we'll get into. Now, there's also a little special sauce involved here. Who knows this guy? If you can't read it, I'll read it off to you, though. For the best tasting barbecue, I like to use the secret sauce. Well, this is just to point out I have my own secret sauce, and that's insider buying and stock buybacks. So we do want to see insider buying by key people in the company, like the CEO or the CFO. If they think it's a good deal, it's probably a good deal right now with the stock price. Same with stock buybacks. It's just a corporate form of insider buying in my book. So, armed with this information, exactly what process are we going to use to screen for these dividend stocks that are undervalued? Well, here it is in a nutshell. First of all, we're going to screen for a 10-year dividend growth rate of greater than or equal to 8% per year. We do this first because this is the highest hurdle for any stock to meet. And as you'll see, this will eliminate a good 50-60 stocks out of the 184 that are in there for the Dividend Champions. Next, we'll look at PEG ratios, then price to book, the dividend yield, dividend payout ratios, less than 50%. We'll look at the intrinsic value or the fair value and make sure that that's greater than the current stock price. Then we'll finally look at net positive insider buying by the key players at each company. And finally, we'll make sure that there's a recent and decent share repurchase program going on. All right, so first we're going to go to this website called dripinvesting.org to use this process to screen for dividend stocks that are undervalued. Now, this is a website maintained by a man, George Smith. He updates the spreadsheets on it on the second day of every month. It's a pretty Spartan-looking website, but nonetheless contains very helpful information to us investors who are interested in dividend-growing stocks. Just go down here to the information and forms area, and you will see a spreadsheet, the Dividend Champion spreadsheet, come up. Maybe. Try that again. And here you find the Dividend Champions list. There's also the Dividend Contenders and the Challengers. So the current Champions list contains a total of 146 stocks. The 146th one is ExxonMobil. Here you will find all the financial information you could possibly ask for about dividend growers. Now, since this video was written in early April, the prices and the metrics seen in the spreadsheet will undoubtedly be very different from the current values. But the purpose of this video is not just to find you certain stocks to buy, but instead it's to give you the process you can use to help you find some stocks on your own. Who was it who once said, give a man a fish, you feed him for one day? I don't know. I do know that if you teach a man to fish, sometimes a law of unintended consequences kicks in. So let's begin our screening process. I would suggest we only look at the champions for now. So we're basically looking at a company with track records of increasing dividends for 25 years in a row. Now, to make this a little bit easier, let's start by sorting these stocks by the 10-year dividend growth rate, since usually this is the biggest hurdle for these stocks to pass. So let's find dividend growth rate. That would be here. DGR, that stands for dividend growth rate. You see it's 1 year, 3 year, 5 year, 10 year. So since we're interested in the 10 year, we're going to go like this, all the way down to the bottom. Then we're going to click on data, sort it, and there you go. So since we're only interested in dividend growth rates of 8% or more over a 10-year period, let's just go to that point, which is right here. Right there, which is Pepsi. So now we will cut this section of stocks out of the rest of them. You see we've eliminated 84 stocks already out of that big list. So we'll just go right across, cut this chunk of stocks out of here, and we'll just put this somewhere below in this other part of the spreadsheet. There they are, starting with Pepsi. And let's see. Let's sort by PEG ratios from lowest to highest, just to make our screening job a little bit easier. So there's PEG ratios right there. So we're going to go down again, and let's sort those puppies. Whoop. All right, semi-retired guys had too much caffeine today. Let's click on this button, sort, and as you can see, now the first company we come to that has at least an 8% 10-year dividend growth rate and the lowest PEG ratio is Polaris, the snowmobile people. That's a consumer discretionary sector. You can see that right here. There's Polaris, there's the sector. We see the PEG ratio is 0.62. Right there. To find the industry average, we look at the bottom of the original list under consumer discretionary, which is right there. Go across the PEG ratio, under consumer discretionaries, and you can see that the PEG ratio average is 2.86. Is 0.62 less than 2.86? I think so. So since it's less than that sector average, we can say that at least this one valuation, Polaris is undervalued. Let's go to price to book now. Price to book ratio for Polaris is 2.68. Now what's the industry average or the sector average? We can see it is 7.55. That sounds kind of high. Okay, so far so good. Now let's look at the dividend yield for Polaris. Dividend yield. There's Polaris. Dividend yield 5.15. At the top of that column. Uh-oh. So remember we said we weren't going to go any higher than 4%. We thought those higher yielders were not as good a performers. So let's move on to the next one. Next one's Albemarle. That's a specialty chemical company, also one of the biggest lithium producers in the world. Their sector is the materials sector. Start with the PEG ratio. We see the PEG is at 0.75. Industry average for the materials sector is 2.72. So we're good. Price to book is, here's your price to book. For Albemarle, it's 1.52. Sector average price to book is 3.58. Now look at dividend yield, 2.73 for Albemarle. So that'll work. Let's see, payout ratio, 30.68. You see the EPS percent payout up there. So that's less than the 50% pay ratio we're looking for. So we'll keep this stock for further scrutiny. We'll look at it again under insider buying and stock repurchase programs. Now, I'm not going to take you through all the remaining stocks, but through the magic of the semi-retired guy's hot tub time machine, here's the final list that has met all this criteria. You can see here I've listed each stock symbol, its sector, its PEG ratio, price to book, dividend yield, payout ratio, 10-year dividend growth rate. I've also added two additional columns, the current price and the fair value. Fair value comes from a website, gurufocus.com. Now you'll see that the company shown in red did not pass the fair value test. In other words, their stock prices were greater than their fair value as calculated by a discounted cash flow method. So with the remaining stocks now, we're going to look at the insider transactions at those companies and also the stock buyback programs in place at those companies. Okay, so here is a PowerPoint of the insider buying and share repurchase programs that are semi-finalists. So we can see here under Albemarle, for example, the CFO bought 16,000 shares. That's pretty good. However, the buyback program, they haven't had any additions to it since 2018. They did have one in 2018, but again, no additions since that time. Also, the buyback program is pretty meager, only 0.8% of their market cap, so we give them a thumbs down. Bank First, CEO sold a net 5 million shares. That was over half of his holdings right there. So once we saw that, we gave them a thumbs down. H.B. Fuller, not bad. Purchases by the CEO and the CFO. However, no recent buyback program or addition to their buyback program. Last one was 2017, thumbs down. T. Rowe Price, on the other hand, CEO bought a lot of shares. CFO did okay. The buyback program is very recent, April 2020. They get a thumbs up. Same with General Dynamics, March 2020. A.O. Smith, not bad on the CEO, CFO, nothing wonderful. A buyback program about 9 months old, not bad. 8% of the market cap is being bought back. They get a thumbs up. Walgreens Boots Alliance, thumbs down. Buyback program is a little bit old, even though they did buy a lot of it back. So in summary, out of an initial list of 184 stocks, we were able to narrow it down to 3, which met our definition of undervalued, even as the entire market has fallen 27%. I hope I've shown you a good process you can use to find undervalued dividend growing stocks. First, we looked at a subset of stocks from companies that we know are good performers, the Dividend Champions and Aristocrats. These have been able to increase their dividends every year for at least 25 years. Then using these various financial metrics, dividend growth rates, PEG ratios, price to book, dividend yields, dividend payout ratios, we're able to determine which ones seem to be good values. Finally, we looked at the intrinsic value or fair value of these stocks using the discounted cash flow method, which we found already calculated for us on the gurufocus.com website. We then looked at the insider trading for key executives like the CEO and the CFO of these companies. Finally, we looked at the stock buyback or share repurchase programs to make sure they were recent programs and that they were buying back a decent amount of their market cap. Through all that, we were able to identify 3 companies that passed all of these tests. Now in our next video, we're going to put the final touches on this process. I need another cliffhanger, of course. We'll look at the Piotrowski F-scores, which is a straightforward way of determining whether a company is in good financial health. We're going to also look at some analyst reports in these companies to determine if there's any upcoming events or business trends that we need to be aware of before making a decision to invest in these companies. Finally, if you like this video, please make sure you check the like box. And if you'd like to subscribe to my channel, I'd love to have you. Just check the subscribe button. And finally, if you want to see how I'm spending my semi-retirement, check out my website, thesemiretiredguy.com. Don't worry, it's not all about stocks. It's mostly about how I spend my spare time. Eating, drinking, reading books, going to movies, and playing with my wonderful dog, Kitty.